Happy Friday, everyone. So good to have you join us on this edition of Business Daily. I'm Ji-yoon in Seoul. Before we get started, let's first get a glimpse of today's highlights. Negative rates and currency depreciation seem to be the new normal among countries that are hoping to lift downward pressure on their economies. Major oil companies' profits collapse amid crashing oil prices while the world's largest trade pact finally gets signed. We look into some of the global business stories that made headlines this week. But first, Korea's budget balance last year ended in the black, marking the first surplus in 4 years. The finance ministry says the country collected roughly $300 billion in revenue, putting the gap with expenditure at around $2.5 billion. The government managed to push up its tax revenue last year by about $2 billion, thanks to improved domestic consumption, a busy real estate market, and a tax law revision that nearly doubled cigarette prices. The amount that the government originally planned to spend in 2015 also dropped compared to a year ago. Those unused funds will be budgeted into this year's spending. Customs duties, however, slumped by around $180 million compared to the previous year, after seeing sluggish imports due to plunging oil prices. Income tax revenues from interest rates also dropped, as the country's key rate is at a record low of 1.5%. The National Assembly finally passed the so-called Oneshot Act on Thursday after sitting on it for over 200 days. The law, which was drawn up to revitalize corporate activities, is expected to streamline restructuring processes for firms and provide tax cuts to companies voluntarily selling or purchasing businesses. Experts say the law is likely to breathe new life into firms in the shipbuilding, steel, petrochemical, and shipping sector that have been suffering from oversupply in the sluggish global economy. But there are concerns that chaebol, or family-owned conglomerates, may take advantage of the Oneshot Act for ownership succession. To address the concern, restructuring plans will not be granted if transfer of ownership is determined as being the underlying reason. The law will go into effect in August. And while the so-called Oneshot Act has been passed into law, others are still sitting at the National Assembly, prompting members of the public to take action. A petition urging lawmakers to pass a series of bills aimed at revitalizing the economy has secured more than 1 million signatures just over 2 weeks into its launch, a tenth of the pledged goal. The campaign, driven by 147 business groups and associations, including Korea Chamber of Commerce and Industry and the Federation of Korean Industries, has been collecting signatures from people both online and booths in public spaces. The petition calls on lawmakers to pass key bills on boosting the service sector and reforming the labor market to prop up tepid growth momentum. The International Monetary Fund is looking to strengthen precautionary financing instruments to counter falling oil and commodities prices. IMF Managing Director Christine Lagarde on Thursday called for a stronger global financial safety net in order to limit the negative effects of cheap oil and China's economic slowdown. She said advanced economies should support growth through infrastructure spending and other steps. And as for emerging economies, Lagarde urged them to boost non-commodity revenues and allow more flexible exchange rate policies. The IMF chief also suggested that the U.S. clearly communicate its plans on raising interest rates with other countries. Central banks around the world are depreciating their currencies to keep themselves competitive. Korea has been no exception, cutting its rate to a record low of 1.5% over the past year or so. And analysts say further cuts could be on the horizon. Our Park Se-young has the details.
The global currency war is intensifying, with central banks in various countries following China's movement to weaken their local currencies. According to Bloomberg, the People's Bank of China cut the yuan midpoint by 0.22% in January after having devalued its local currency by nearly 5% in just 4 days last August. The PBOC did on Thursday raise the yuan fixing by 0.16% to fight off bearish sentiments. The Bank of Japan recently adopted a negative interest rate strategy, which will in effect drive down the yen. The European Central Bank, having rolled out a negative rate policy in 2014, is likely to cut its interest rates again in March. Global investment banks are extending their forecast of the Bank of Korea lowering its benchmark interest rate within the first 3 months of a year. Speculation of a rate cut at this month's policy meeting rose sharply after the BOJ's interest rate announcement following concerns of a Korean won appreciating against the yen and hurting exporters. Korea's exports shrank 18.5% on-year in January, the biggest drop since 2009. But the country's heavy household debt and the potential of a faster outflow of foreign capital are factors that could prevent the BOK from lowering rates further. Park Se-young, Business Daily.
After today is the start of a 5-day extended break for most Koreans in the country, with the Seollal or the Lunar New Year holiday beginning on Monday. And a lot of people use this holiday to travel abroad, which is why currency exchange counters at banks get extremely busy this time around. And our Lee Ju-young tells us where they go to get the best deals.
This is KB Kookmin Bank's newly opened currency exchange center at Seoul Station, joining two others, each run by the Industrial Bank of Korea and Uri Bank. With the Korean won remaining weak against the US dollar, higher discounts through preferential rates on conversion fees make these exchange centers even more attractive.
If I go to other branches, I only get about a 50% preferential rate. But here, I can get up to 90%.
In other words, if a traveler were to exchange the local currency to secure 5,000 US dollars through a commercial bank outside of the station, they would need 6.08 million won after getting 50% off on conversion fees. But at the Money Exchange Center inside Seoul Station, they receive a steep discount of 90% on fees, which means they only need 6.03 million won. For the same amount, customers can shave off about 50,000 won or $41. These centers are most popular among tourists who visit the station to use the city airport terminal.
We offer the lowest rate in the nation, offering up to 90% off on conversion fees. It's also right in front of the immigration counter, and we're open all year round.
Travelers can exchange up to 18 different currencies with a cap of 1 million won per person. Lee Ju-young, Business Daily.
And time now for a deeper look into global issues that made headlines this week. And for that, we're now joined by our Eunice Kim in the studio. Hello, Eunice.
Hello, June.
All right, so the headlines this week has been oil, and more oil.
Yeah.
Markets have been volatile, and the oil prices have been zigzagging all this week. And we got a data dump out of oil companies this week,
Right.
giving us a sense of how bad things are for them.
You're absolutely right. You know, typically these large global companies have more ammo to fend off the effects of low oil prices, certainly more than their independent and smaller counterparts. But now, even the giants, BP, ExxonMobil, and Shell, all took a beating in the fourth quarter of last year, posting losses in the billions of dollars in 2015. Now, let's start with BP. The British multinational recorded its worst annual loss in 20 years at $6.5 billion, driven down by a 90% plunge in fourth quarter underlying profit. 90%. Now, expecting oil prices to remain low for most of this year, it said it would cut another 7,000 jobs, 4,000 in exploration and 3,000 from downstream refining. Put on watch by credit rating agency S&P on Wednesday, U.S. oil giant ExxonMobil actually did a little bit better, but still shedding 58% in the fourth quarter for an annual profit of $2.78 billion. And finally, Europe's largest oil company, Royal Dutch Shell, saw its profits plunge by 87% in 2015 to less than $2 billion. Its chief executive said the company will unload $10 billion in assets in addition to the previously announced 10,000 job cut, all part of substantial changes being adopted to cope with this extended stretch of low oil.
Now, those are some eye-watering losses indeed. But Eunice, this low oil price trend is not only affecting multinational companies, it's actually pushing an entire country over the ledge.
Yeah, you're absolutely right. And of course, we're talking about the oil-producing developing nations here, where bad situations are being made downright disastrous by historically low oil prices, a commodity they draw so much of their income from. I've prepared a rundown. Take a look.
Many countries keep IMF Managing Director Christine Lagarde awake at night. Chief among them, she said this week, is Nigeria. The OPEC member state and Africa's largest economy is hurting from the deep dive in the cost of crude. Grappling with a $15 billion state deficit, the Nigerian government has asked for emergency help amounting to $3.5 billion from the World Bank and the African Development Bank. Crude's contribution to Nigeria's income is forecast to shrink from 70% to just 33% this year.
First and foremost, is it a good idea to borrow? Yes. Is it a good idea to spend and fund your budget by deficit, thereby stimulating the economy and jump-starting it into growth? Yes. Is it a good idea, or is it efficient to borrow from the multilaterals at concessionary rates? It's an excellent idea. So all told, this is the best way to go for Nigeria.
Nigeria is not alone. Over at the border of Asia and Europe, Azerbaijan is mulling over an ask of $4 billion. The nation of 10 million people has relied on oil to bring in some 37% of its GDP and close to 90% of its exports. $30 a barrel oil prices has put immense pressure on the country. Its currency more than halved against the greenback in the past year. Edging dangerously close to a sovereign default is Venezuela, a state believed to have the richest crude reserves in the world. But reports this week say it's importing U.S. oil because that was cheaper than extracting and refining its own. Angola, Algeria, Iraq, Libya. There's no shortage of emerging countries nervously watching their state coffers go from full in the days of $100 a barrel oil drop to empty. It's raising concern that crisis could be around the bend, not unlike the default-ridden oil glut of the 1980s.
So two of the countries that you mentioned in the report are the members of the OPEC, which of course is the oil cartel and in part driving this oil glut.
Right.
Is there anything they can do?
Well, in fact, there are rumors swirling right now that there is an extraordinary meeting in the works being planned between OPEC and non-OPEC nations to discuss this very issue of production. And we know Venezuela is one of those countries that has been pressing OPEC to revisit its production levels. But the country with the biggest say in OPEC is, of course, Saudi Arabia, and it's refused to budge. The Wall Street Journal today even reporting that it has actually cut prices of its best quality crude headed to Asia and Europe. This certainly won't help the plight of its smaller OPEC counterparts, with oil now selling for 70% less than what it was in mid-2014. And Morgan Stanley just yesterday did downgrade its already pessimistic outlook on oil, saying it now sees crude mostly falling throughout the year, with Brent crude to average only $29 a barrel by the fourth quarter. It expects supply and demand to be disjointed even more, exacerbated by rising inventories and increased hedging incentives.
All right, let's shift our focus a little bit and turn to the TransPacific Partnership. This world's largest free trade pact marked a milestone yesterday when the deal was finally signed in New Zealand.
Yeah, you're absolutely right. This was a culmination of 5 years of negotiations among the 12 countries spanning 4 continents. The TPP trade deal, spearheaded by the U.S. and Japan, was inked in Auckland by representatives from the Pacific Rim nations, including Australia, Brunei, Vietnam, and Mexico. New Zealand's Prime Minister John Key said the hard work is now ahead.
Signature today is an important step. But TPP is still just a piece of paper, or rather over 16,000 pieces of paper, until it actually comes into force.
And that next step is expected to take at least 2 years of tough negotiations, starting in the U.S., where the trade pact is emerging as a controversial presidential election issue. President Barack Obama, of course, his term is set to expire at the start of next year. And over in Japan, TPP's main negotiator, former economics minister Akira Amari, did resign from his post last week amid allegations of bribery. So this could cause a pause in the traction around TPP there as well.
I also heard that some experts forecast that the TPP will reduce Korea's exports by 1% and Korea's GDP by 0.3% in the long term, definitely dealing a blow to the already struggling domestic exporters.
Right, absolutely.
All right, thank you so much for coming in today.
Sure thing.
And that wraps it up for today and this week. But we'll be back with more next Tuesday after the Lunar New Year holiday, so don't forget to tune in then. Thanks for watching, and for those of you here in Korea heading to countrysides to visit family and friends, drive safely and happy Lunar New Year holiday.